Okay, so why are mortgage rates going up and not down? Let me explain. Anyone thinking of buying their first home or moving into their new one will watched recently of the increases in mortgage rates with deep concern, I would say. But the key here is in the last 2 weeks, they've seen a string of lenders raise their interest rates on the new fixed rate mortgage deals. This included people like Santander, NatWest, and Nationwide. So why have they done that, and why have rises have made borrowing more expensive as a result? And potentially will mean that some people will have to postpone their plans, thus restricting the buyer's market, possibly at the top end of the market, because since 2021 to now, mortgage rates affordability has gone up by 60%. So 60% more costs on the mortgages. So more than 1.5 million existing homeowners are remortgaging this year, and they too expect expected rates to be actually falling, not heading back up. So why are the rates heading back up? Why are they going upwards? The answer can be quite complex and varied, but here are three reasons why. Um, Borrowing is clearly more expensive. We can see that. Mortgage rates often preempt moves by the Bank of England with benchmark interest rates, also known as the base rate. Remember, higher rates makes it more expensive to borrow money. Markets move as they try to predict what the bank's monetary policy committee will do, and in turn, this affects mortgage lenders' funding costs. Swap rates are when two parties exchange or swap interest rates to secure funding over a set period of time. Swap rates actually influence the price of fixed rate mortgage deals. And right now, fixed rates have risen because the cost of borrowing has increased for lenders. Now, that's a number of factors like numerous rises in base rates. You've really got to thank for that. The bank's monetary policy committee and the Bank of England's monetary policy committee next it makes its next decision on Thursday coming, crucially. So it's now expected to cut the rate as early or as often previously thought. So it's now not expected to cut the rate as early or as often as previously thought. Hence the reason why fixed rate deals are going up, because swap rates then have gone up as well, because everybody expected them to come down, the base rates, over a period of time, and preempted that and brought their lending rates down as well. And that's not about to happen anytime soon. So the impact of those expectations eventually feeds through to mortgage rates, which have been creeping back up as a result. Let's take a quick look at that actually. I'll give you a look at that chart here. Here we can see it there. So what have we got here? We've got 2-year fixed rate and 5-year fixed rate deals. The 2-year is the red line over the period of 2022 to 2024, and the blue is the 5-year fixed rate deals. So you can see that there. Now you can see what happened there now when 2022, it was actually quite low for this. The mini budget came along in September 2022, Liz Truss's famous mini budget, which threw everything into disarray and increased rates sky high because there was uncertainty there. And then when she basically got removed, and so did our Chancellor, and Jeremy Hunt came in and secured everything, the banks actually had more, and the UK economy had more faith in Jeremy Hunt's budget. Therefore, rates actually started to come down as a natural result. 2023 saw July 2023 saw mortgage rates, base rates going up as well as a result. Here, therefore, they actually went up, and everybody was predicting it would go higher and higher and higher. They started to level out, and therefore the rate started to come down towards the end to a 2-year fixed rate deal, an average of 5.93, and a 5-year fixed rate deal of 5.5 overall. So lenders had engaged really in that price war at the start of the year, and the average interest rate of the 2-year fixed rate deal had dropped to 5.5% near the end of January, according to the Financial Services Money Facts. But that is all good as it is for mortgage seekers. But it has moved up since some flurry of activity in the last fortnight and pushed the average rate up to 5.93. This has worried everybody whose mortgage has gone up for renewal on October, for example. Let's take Gary Rees, for example. A 51-year-old from Berkshire was paying £350 per month with a mortgage interest rate of 2.4%. He was worried that the rate could actually close to a triple by the time he renews. And he said actually he'll have to cut back and not go as much. But Mr. Rees, who's actually registered blind as a natural result of that, for this. So he's worried about this overall. He's also considering the prospect of having savings offset by some of the mortgage interest to pay down some of the capital. So in other words, if you got savings, you could put them into an offset deal and get an offset mortgage, which will make the capital go down quicker. Therefore, the interest rate will be a lot less to pay back the interest costs. This will affect his standard of living, no doubt, but it was not quite as what he was expecting. The mortgage is a worry and a stress that he feels a bit unfair, he said, but he was hoping that rates would actually drop overall, as most people were. I don't think they're going to drop anytime soon as a natural result of this, what's going on. Maybe if inflation starts to come down and starts to level off, that might have a possibility they might have to drop. But there's information on the horizon which suggests that inflation might not come down as expected, even though they announced it today and said it again in the Parliament and the Treasury questions at Parliament today. So the second one is why it has actually mortgage rates are going up and not down. Lenders don't want too many customers. It's a surprise, eh? Lenders do not want too many customers. Well, what do we mean by why is that? Well, mortgage brokers are keen to stress that the moves in recent days are not as a cycle of rapidly rising rates. It's the likes of what we've seen in the last 2 years. The graphic we're actually shown before shows the mortgage rates are still below last summer's peak and are not accelerating as alarmingly as they did in the mini budget of 2022. However, some borrowers had banked on the rates going down consistently throughout the year. Two more key factors have created the current bump in the road. Firstly, global economic outlook has not been as positive as many would have thought and hoped for. On Wednesday, the US central bank said again it would keep interest rates unchanged because the high rate of rising prices, that's inflation, and had proved more persistent than expected. Secondly, lenders tend to move in a pack. So they all keep together, sort of. So one moves in the rates, the others move in the rates as well. So the mortgage provider wants to set its rates to be competitive, but not too low to suddenly inundate itself with custom and able to cope with that demand because they've only got a finite amount of money. So therefore, they make sure they put the rates up to an amount where it's equivalent to everybody else's. So they don't get too many customers running at the same time, or basically they close their doors and that's it. That's that mortgage rate ended, and they'll never be able to give that for quite a while because they don't have enough money to lend out to people from then onwards. So in reality, home buyers and owners in pounds and pence is that it's compared to someone getting a mortgage a year ago, it's a little more expensive overall. So the property portal Rightmove actually estimates that the average mortgage payment on a typical first-time buyer property, when taking out an average 5-year fixed-rate deal, 85% loan-to-value mortgage, is now £1,117 per month, up from £1,056 a year ago. So it's gone up ever so slightly. However, for those remortgaging as a 2-year or particularly a 5-year current deal expires, the monthly cost could be hundreds of pounds higher because the rate they have been in has been below 2% when they got their last deal overall. So that's why lenders don't want to lend to have too many customers because it overwhelms them and then it clears their books for them from their money too quickly. The third and final one is what the Bank of England says has a big impact overall. Let me explain. So the outlook for the coming months among commentators is still broadly more positive, but will create some food for thought for borrowers. It's not all one-way traffic here and could change soon. But any suggestions from the bank that it could move soon on benchmark interest rates, even if it holds at the current level on Thursday, could actually bring mortgage rates down again. So if there's an indication on Thursday that mortgage rates could come down in the near future, then you know, 2-year and 5-year fixed rate deals might end up coming down again. So that's important to listen out for that key information. Matt Smith from Rightmove actually says that the Bank of England meeting will be quite key for setting the tone for mortgage rates leading into the summer. The markets are still expected base rate cuts as the year goes on, but quite how far and how often the bank goes with them is open to question overall. Any remortgaging then, for example, may have 3 or 6 months periods, 6 months prior to the deadline to lock in a deal. So anyone, you know, looking to remortgage because their deal's going to be coming out soon, you should get in touch with your bank well before then, because you might have 3 or 6 months before it's actually due to expire to be able to fix into a rate. Now, this is not an exercise when you do that in gambling. And what I mean is you don't throw caution to the wind. If the deal makes sense for you at the current rate that the bank's offering you, then possibly you should seriously think about taking that. Because what happens if base rates maybe go up and the mortgage markets respond by putting their rates up as well when your deal actually finally comes out? And it takes a wee bit of time for it to go through as well when you agree it with the bank. So it might take a wee bit of time. So then you might drop into a variable rate for that period of time, maybe 2 or 3 months, if you leave it too late to fix for your next rate, your next deal overall on your mortgage. And that might leave you exposed to a current variable rate, maybe about 8%, which could be even worse. So that's why I say it's important to, you know, get some stability, get consistency, and understand where you are for budgeting purposes. Doing nothing then during a time of uncertainty can be expensive if borrowers are moved onto a default rate, as I said, before their fixed rate deal expires. So there's plenty of good deals available still, and it's a good reminder not to wait for a better deal to become available, as rates don't always follow predictions and expectations. If your mortgage is up for renewal, you can contact us if you want, and we'll put you in touch with the right mortgage brokers. Whether you're a buy-to-let, or whether you're refinancing on buy-to-let, or whether you're refinancing on your existing residential home, it's easy to put you in touch with the right person. Until next time, guys, I'm Jim Parker for Fife Properties TV.